Hey there, Canadian wealth secret seekers. It's Kyle here, and today we're going to dig into a secret sauce episode where we are going to unpack a client question that comes in, and it comes in quite often. And many of you may have had this idea rolling around in your minds, and it's actually probably held you back from getting yourself started on your true wealth building journey, utilizing leverage against one of the most foundational assets that you can add to your repertoire. So we're going to dig into that and talk about some of the opportunity costs that you might experience when you implement what we call the most foundational asset, permanent insurance. Here we go. All right. So in today's episode, we are digging right in, and we're not going to waste any time. We've got a question here from a client. It's actually a listener who has come in from Canada, of course, the other side of Canada. And we've had a couple of calls digging into their situation. So this client is a real estate investor. They actually have a primary residence they own personally with him and his spouse. They own and operate an incorporated business, and they have kind of done a little bit of house hacking, and they intend to do it again. So they intend to purchase another property personally and house hack that while keeping the original home as a rental property. So they're doing all the things, growing a business, growing the real estate portfolio, and at the same time, they're trying to think about how can we do and optimize this in the most tax efficient way while also growing foundational assets at the same time. So we've gone down the rabbit hole of permanent insurance, specifically high early cash value permanent life insurance through participating whole life insurance. And we've had a couple of calls, and we've been looking at policies that have a max funding premium amount of about $100,000. That puts their minimum premium amount down to around $38,000 or so for these individuals. And they are getting really eager to dig in. And this is the question that came in, which is not the first time that we've had this question. This one is, it says, "Hey, Kyle, we've really enjoyed the call with you this morning. The first call was just with the one spouse. This morning was the second call with both spouses to bring them up to speed." They say, I'm not going to say the name. Let me know that you helped bring them up to speed with the options and the way that we can do things to give us personally and as a business. So thanks to you. We were wondering, here's the key question: if we were to fund a new high early cash value policy as soon as possible with close to $100,000 of premium, how soon are we able to leverage it? The reason is we have an investment that we could make with that cash. It would work to about $45,000 in. Curious to hear your thoughts. Many thanks. And it's signed by the specific client, as you can see up on the screen. All right. So there you have it. We've got a great question here. And the question is, how soon can we leverage it? As many of you may or may not know, it's not going to be a one-to-one, especially if it's a smaller policy. Of course, if it's a larger policy size, we can get 100% of cash value out with a third-party lender. We also have some secondary lenders for those who want 100% premium to come out. Again, these would be on larger policies than just 100,000 of premium. If that's you, of course, reach out to us. We can work with you on that. But in this particular case, a policy of around 100,000, you've got two options. You can go directly to the insurer, and this is pretty much once the policy goes into force. All right. Now, if it goes in force today, you probably are not going to be able to get it today. I always like to say, give yourself like a 30-day window, just so that you've got some time, a little bit of breathing room here. But assuming that any investment that you're going to make, that there's a little bit of wiggle room here, there should be a good chunk of cash value available depending on the policy structure and also depending on how you choose to fund it. If we max fund a policy, we will have access to more cash value immediately. So what I'm going to do is I'm going to bring up on the screen an example, because this particular policy was actually put in force just earlier this week. So you'll notice here, I've blocked off some information, some important information, so that there's no identifying information on the screen. Now, this particular policy was a client who has a $100,000 premium, maximum premium policy. That means they can put in as little as about 40,000 and as much as about 100,000. They also took the option to backdate this policy 364 days. Now, some people would say, like, why would you ever backdate a policy? Why would you want to pay for insurance for the year that's already happened, especially when it's life insurance and we're still here, we're still alive? Well, with a permanent policy, a high early cash value policy, what you're doing is you're getting two things. You're getting a cheaper cost of insurance because now on the record, it's saying you're a year younger when you're putting it in force. And the second thing you're getting to do is you're actually getting to fund 2 full years right away. So you get to update, or you get to fund the full premium of the year that's already passed, and you get to fund the full year of this year's premium. Normally, you're just funding the first year. Now you're funding essentially the first 2 years of the policy, which means you're going to have even more cash value available. So this individual actually took $1,000. They backdated the policy. They fully funded it with $200,000, which gives them a total cash surrender value of about $175, it says here on the screen. But you'll notice the loan available is not exactly, and it's actually less than 90% of the cash surrender value. Now, if we went to a third-party lender, okay, which would require underwriting, and they'd have to actually agree to do this lending for you. In most cases, if you're able to be approved for the policy due to your cash flows and your assets, you're usually going to be okay on this side as well. You could get the full cash surrender value. This is representing what it will be worth by the end of this year. So that would be great. However, if we just want the easy loan, like we just need this money fast, we don't want any additional underwriting, we can ask the insurer to send us this loan by hitting the loan request button or request a loan button here. Now, because the policy is brand new, they're actually only giving you, or this individual, access to $125,000 of the 200 that they put in. 125 of 200, as you'll see on the screen, about 62.5% of the premium that this individual just put in earlier this week is available through a policy loan through the insurance company. All right. So this is one insurer. Every insurer is a little bit different, but I wanted to give you an example. In this particular case with these clients, this would be the insurer that we would be going with, or I'd be suggesting that they go with, because they do want to have that immediate availability of those funds, but they also want to have a policy that's going to grow at a high level. So it has a high scale, dividend scale, and they're actually a mutual company for those who have done a little bit of digging, and they understand that a mutual company is actually not publicly traded, which means there's no other shareholders that we have to actually give profits to. So these are things and some of the reasons why we would pick this particular insurer in this particular case. But the moral of this story is, if these clients are putting in $100,000 into this policy today, within the next couple of weeks, once this policy settles and all the dust settles, there will be a loan request button there for a loan available. And I would argue on 100,000, you would likely be able to achieve at least 50%. I don't want to promise you 62.5% here, or 62.5% or immediately, specifically, unless you're going to also be doing 2 years worth of funding, because there is a little bit of an impact there that's going to release more cash value immediately. However, the $45,000 that they are looking for, if they were to take $100,000 of premium and go ahead and put that $100,000 in, they should have no problem in getting this 45 out immediately to reinvest. Now, the other nuance is that throughout the year, the cash value and the loan available is going to continue growing all the way up until the end of the year. So when we look at illustrations, we're typically looking by year end at what we see in the chart. We don't really know exactly what's going to happen in the in-betweens there. But what we can say is that the longer we hold this policy, so next month, the month after that, we're going to see that the loan available to us will continue to grow, as well as the actual cash value continues to grow over time as well. So the easy answer to this question is, in this particular case, they were already looking at taking retained earnings from their incorporated business and putting it into a high early cash value permanent policy to create this foundational asset, which is going to give them a large death benefit, which will pay out at some point down the road and will provide a lot of tax-free dividends to come out through the capital dividend account through the death benefit down the road. They also have the leverage ability so that they can continue doing the investing they were planning to do while keeping some of that dry powder in there, growing and accumulating tax-free as cash value, the living benefit of this particular policy. So in today's episode, I hope you found and learned a little bit about the fact that if we are starting a permanent life insurance policy, whether you're on the personal side looking to do something like infinite banking, or for me, I always like to look at it as an investment tool in the shorter term and a cash flow tool in the longer term, with a massive tax efficiency all along the way with that large death benefit paying out in the end. It doesn't matter who you are, but knowing that there is a little bit of opportunity cost if you're going to start a high early cash value policy. However, it's not a high enough opportunity cost to restrict you from actually doing it, because you can still be investing while you do some of this work. And I would argue that for the vast majority of the population out there, very few people are willing to take all of their dry powder, the capital they have available to them, and put it into a long-term asset all at once. Typically, you want to keep some of that protected and safe. Well, in doing something like this, you're getting a bit of both worlds. You're going to get something that you can put into the risk-on asset. In their case, it's going to be real estate. And each and every day, you're growing more and more of that liquid cash value to sit alongside here in case of a business shortcoming, that cash flow crunch, or potentially that next investment opportunity down the road. So, my friends, if you found this useful, do us a huge favor, hit the subscribe button, hit the like button and the bell if you're on YouTube with us. And of course, ratings and reviews help to go a long way. If you are interested in getting your wealth plan organized and get some feedback, head on over to CanadianWealthSecrets.com/discovery. There, you'll be able to take a short quiz to determine what phase of the wealth building journey are you at and what next steps should you be taking. If you're ready to take the next step with us, you'll have the opportunity to book a call over on the Discovery call page, CanadianWealthSecrets.com/discovery. And if you're an incorporated business owner, hop into our Incorporated Business Owners Masterclass, where you can learn more about these types of strategies and more over at CanadianWealthSecrets.com/masterclass. And as a reminder, all Canadian Wealth Secrets seekers, this is for informational purposes only. You should not construe any such information as educational, financial, accounting, or legal tax advice. But a reminder that I am a licensed life and accident and sickness insurance agent, and you can reach out to me over at the PanCorp team, which includes corporate advisors and Pan Financial.